The investors who made the most money in the 2008 financial crisis did absolutely nothing for the first 6 months. And that was the precise strategy. Look, right now, the stock market is flashing red. Everyone is panicking, liquidating their entire portfolios, and screaming that cash is king. But here is the harsh, uncomfortable truth your financial advisor is likely hiding from you. Blindly hoarding cash in a high-inflation crash is financial suicide. To not just survive the coming storm, but actually build generational wealth when everyone else is losing their shirts, you don't need panic. You need a mathematical baseline. You need an exact number invested, strategically deployed to protect your downside. In this video, I am going to break down the exact formula to calculate your personal survival baseline. But more importantly, I'm going to reveal the ultimate wealth transfer asset that the top 1% quietly bought at the absolute bottom of the last crash. Most retail investors completely ignore it, but if you stick with me, you'll see exactly why the world's billionaires backed up the truck for it. Let's look at what is actually happening behind the scenes. Most people think a market crash is just a bunch of numbers turning red on a screen. They think it's just bad luck or a bad news cycle. It's not. A crash is a structural breakdown of reality. Look at this specific number right here, margin debt. Before every major collapse in history, whether it was the dot-com bubble or the Great Financial Crisis, this number hit an all-time high relative to GDP. Why does this matter to you? Because when the market dips just 5 or 10%, it triggers a margin call cascade. Imagine a row of dominoes where every domino is made of borrowed money. When the first one falls, the rest don't just tip, they explode. This is called deleveraging. In this phase, institutions aren't selling because they want to. They are selling because they have to. They are forced to liquidate their best assets, the ones you're probably holding right now, just to cover their losses elsewhere. This is the liquidity black hole, where trillions of dollars of perceived wealth simply evaporate into thin air in a matter of days. If you don't understand the physics of this collapse, you are essentially standing in front of a tidal wave with a bucket. But here's where it gets interesting. While the masses are drowning, a very specific group of people is building an ark. And it starts with understanding the survival baseline. The reason 90% of retail investors get liquidated during a crash is simple. They have a ceiling, their dreams of 10 times returns, but they don't have a floor. Your survival baseline is not about your net worth. It's not about how much your portfolio says it's worth on a green day. It's about your liquid durability. Think about it this way. Imagine the market drops 50% tomorrow and stays there for 24 months. Ask yourself, honestly, would you be forced to sell your stocks at the absolute bottom just to pay your mortgage or buy groceries? That forced selling is the single greatest destroyer of wealth in human history. To calculate your baseline, we aren't looking at emergency funds in the traditional sense. We are looking at the volatility buffer. This is the exact dollar amount that must remain in non-correlated liquid assets to ensure that no matter how deep the red goes, your lifestyle remains untouched. If you don't have this number fixed in your head right now, you aren't investing. You are gambling with a debt-loaded gun pointed at your future. In the next few minutes, I'm going to give you the exact formula to find this number. But first, we need to talk about the shield, because where you put this money is just as important as how much it is. Now that you have your survival number, where do you put it? Most experts will tell you to just park it in a broad market index fund and wait it out. Here's the controversy moment that usually gets me canceled by the bogleheads. index funds will destroy your wealth in a crash, and I have the math to prove it. Go ahead, pause the video, rewind that. Type your angry comment below. I'll wait. Done? Now, let me explain why the safety of diversification is a mathematical lie during a liquidity crisis. In a true market meltdown, correlations go to 1. That means everything: tech, energy, retail, and even your safe index funds drops at exactly the same time. If you are 100% indexed, you aren't diversified. You are just a passenger on a sinking ship with no lifeboat. The Shield isn't an index fund. The Shield is a portfolio of uncorrelated assets. We are talking about short-term treasury bills, physical gold, and specific cash equivalents that actually gain value or hold steady when the S&P 500 is bleeding 3% a day. The goal of Asset Class 1 isn't to make you rich. It's to ensure that when the index fund trap snaps shut on everyone else, you have the liquidity to be the buyer of last resort. But having a shield is only half the battle. You also need a moat. If the shield is what stops you from bleeding out, the cash moat is what gives you the power to counterattack. But let's get one thing straight. I'm not talking about the 2% interest savings account your grandmother told you to keep. In a high inflation crash, that kind of cash is a melting ice cube. The strategic cash mode is different. It is capital specifically set aside, not for bills, but for blood. Baron Rothschild famously said, "Buy when there is blood in the streets, even if the blood is your own." But you can't buy the dip if your dip buying money is currently losing 30% of its value in the tech sector. Look at this chart of cash levels held by Berkshire Hathaway over the last decade. Notice something? Warren Buffett doesn't keep $150 billion in cash because he's afraid. He keeps it because he is patient. He is waiting for the moment when high-quality companies are sold at liquidation prices by people who didn't have a moat. Your moat needs to be in a very specific vehicle, something liquid enough to deploy in 24 hours, but secure enough that a bank run won't freeze it. We're talking about high-yield money market funds or specific ultra-short-term bond ETFs. Without this moat, you're just a spectator watching the greatest wealth transfer in history happen to other people. With it, you become the predator. Now, let's get to the math. How do you actually calculate the exact dollar amount for your specific life? Let's get tactical. Forget the generic 3 to 6 month emergency fund advice. That's for people trying to survive a job loss. We are talking about surviving a systemic financial collapse. Stop the video right now. Open the Notes app on your phone or grab a piece of paper. You need to see your own survival baseline in black and white, or you're just watching entertainment, not building a strategy. Here's the formula for liquid durability. First, calculate your monthly burn rate. Not your I'm living large budget, but your the world is ending survival budget. Rent, food, utilities, health insurance. Let's say that's $4,000. Second, the time horizon. Historical data shows that major bear markets take an average of 18 to 24 months to fully recover. We don't plan for the best case scenario. We plan for the 24-month grind. $4,000 times 24 months equals $96,000. Third, and this is the part everyone misses, opportunity capital. This is the extra 15% you add to that total, strictly for buying assets when the RSI hits the floor. If your total is $110,000, and you only have $20,000 in your shield and moat, you are mathematically over-leveraged. You aren't investing your extra cash. You're standing on a trap door. Once you have this number, every dollar you invest above it is where true wealth is created. But if you're below it, you're a ticking time bomb. Speaking of time bombs, we need to talk about the psychological trap that is currently being set for you. Your brain is not wired for investing. It is wired for survival on the African savanna 50,000 years ago. When you see your portfolio drop 30%, your prefrontal cortex, the part of your brain that understands long-term compounding, literally shuts down. Instead, your amygdala takes over. This is the amygdala hijack. It's the same biological response as being hunted by a predator. Your heart rate increases, your vision narrows, and your DNA screams at you to do one thing: run. In the stock market, running means selling. This is why loss aversion is a killer. Behavioral economists have proven that the pain of losing $10,000 is twice as intense as the joy of gaining $10,000. This asymmetry is the death trap. It forces you to sell at the absolute bottom because your brain just wants the pain to stop. The market makers, the hedge funds, the 1%, they know this. They aren't just trading stocks, they are trading your cortisol levels. They wait for the moment of maximum pain, when the last retail investor finally gives up and clicks sell all, because that is the exact moment they start buying. To survive, you must stop being a biological creature and start being a machine. And that starts with a strategy that balances the extreme ends of the spectrum, the Barbell Strategy. To stop being a victim of the market's volatility, you must adopt a structure that actually thrives on chaos. This is called the Barbell Strategy. Most investors do the exact opposite. They stay in the middle. They buy moderate-risk stocks, balanced mutual funds, or the very index funds we just discussed. But in a crash, the middle is the kill zone. It's where you have enough risk to lose everything, but not enough safety to buy the bottom. The barbell is different. On one end, you have your fortress. This is 85 to 90% of your portfolio. It's not in the market. It's in ultra-safe, hyper-liquid assets. This is your shield and your moat. This 90% ensures that no matter what happens, even if the S&P 500 goes to zero, you can still eat, you still have a home, and you never, ever have to sell a single share out of desperation. On the other end, you have your moonshots. This is the remaining 10 to 15%. This money is not for safe returns. This is for high-convexity bets. When the market hits maximum pain, you take this capital and you buy the most distressed, high-quality assets available. Things that have the potential to return 10 times, 20 times, or even 50 times during the recovery. By cutting out the middle, you protect your downside while leaving the door wide open for explosive, life-changing gains. But to make this work, you need to know exactly which historical winners to study. Let's look at the people who actually did this in 2008. To understand where we are going, we have to look at where we've been. Look at this chart. This is the 2008 Great Financial Crisis. The blue line shows retail investors, people like you and me, panic selling as the market dropped 20, 30, and eventually 50%. But notice the gold line. This is the smart money. While the masses were screaming on CNBC, the world's most successful investors were doing something counterintuitive. They were waiting. Think about Warren Buffett. In the middle of the 2008 chaos, he didn't just buy stocks. He used his cash moat to strike a deal with Goldman Sachs that the average person couldn't even dream of. He got a 10% dividend and warrants to buy more shares at a discount. He wasn't gambling on a recovery. He was providing liquidity when the world had none. The lesson here isn't to be Warren Buffett. The lesson is that the winners of 2008 had their survival baseline covered before the first Lehman Brothers domino fell. Because they knew they wouldn't starve, They had the psychological coldness to look at a 50% discount not as a tragedy, but as a once-in-a-generation wealth transfer. If you are waiting for the news to tell you it's safe to buy, you've already lost. The winners buy when the news is at its most terrifying, but before you can buy, you have to clean house. You need to know what to cut, and you need to do it now. Everyone wants to talk about what to buy, but you cannot build a fortress on top of a landfill. Before you deploy your survival baseline, you must have the courage to kill your darlings. There are 3 types of assets that will be absolute dead weight in a liquidity crash. 1. The zombie companies. These are firms that don't make enough profit to even cover the interest on their debt. In a low interest rate world, they survive. In a crash, when credit markets freeze, they vanish. If you are holding companies with negative cash flow and massive debt loads, you aren't an investor, you're a donor. 2. The hype multiples. Look at companies trading at 50, 80, or 100 times earnings. In a bull market, that's called growth. In a crash, that's called gravity. When the bubble pops, the first thing to go is the premium. These stocks don't just drop, they crater. 3. The safe dividend trap. Many investors flee to high-dividend stocks for safety. But watch out. If a company is paying a 10% dividend while their business model is crumbling, that dividend will be the first thing they cut to survive. When the dividend disappears, so do the investors, and the stock price collapses. Don't fall for the sunk cost fallacy. Just because you bought a stock at $100 doesn't mean it has to go back there. Selling at $70 to protect your remaining $70 is a win. Keeping it until it hits $20 is a tragedy. Purge the toxic, consolidate the winners, and prepare for the next step. Because once your house is clean, you need to make sure you never have to make a manual decision again. You need to automate. Here's a truth that might hurt your ego. You are the single greatest threat to your own wealth. Even with the best strategy, when the market is down 40% and your Twitter feed is screaming, "The end is near," your willpower will eventually fail. This is why the world's most successful institutional investors don't rely on grit. They rely on systems. To survive a crash, you must automate your survival baseline maintenance. This means setting up automatic transfers that divert a portion of every paycheck into your shield and moat before you even see the money. If you have to think about it, you probably won't do it when things get scary. But the real secret isn't just automated buying. It's automated rebalancing. Imagine your moonshots grow from 10% of your portfolio to 30% because of a lucky streak. Now, you're overexposed. A crash would devastate you. An automated system would harvest those gains and move them back into your fortress without you having to fight your own greed. By the time the crash actually hits, your survival baseline should be a self-sustaining ecosystem that functions whether you're awake, asleep, or in a state of total panic. You've built the fortress. You've automated the gates. Now, we need to test if it can actually withstand a direct hit. It's time for the stress test. It's easy to have diamond hands when the sun is shining. But can your strategy survive a direct hit from a Category 5 financial hurricane? Let's find out. We're going to run a 3-step extreme stress test on your portfolio right now. Step 1. The 40% flash crash. Imagine you wake up tomorrow and the S&P 500 is down 40%. Not over a year, but in a week. Look at your total account balance, cut it in half. Now, look at your monthly expenses. If you feel a knot in your stomach because you realize you'd have to sell your favorite stock at that price just to keep the lights on, you have failed step 1. You are over-leveraged. Step 2. The liquidity squeeze. Check your shield. is that money actually reachable? If it's locked in a 5-year CD, a retirement account with heavy early withdrawal penalties, or a physical asset you can't sell in 48 hours, it doesn't count. In a crash, speed is a hedge. If you can't touch your survival baseline by Friday, you failed Step 2. Step 3. The duration test. Assume the market stays at that minus 40% level for 730 days. No V-shaped recovery. No Fed bailout. Just a long, cold winter. Does your cash moat hold up, or does it run dry in month 6? If you failed even one of these steps, don't panic. The time to fail a stress test is now. While the numbers are just pixels on a screen, it's much cheaper to fix your strategy today than to learn these lessons when the bailiffs are knocking on your door. Once you pass the test, you're ready for the ultimate prize, knowing when the blood has stopped flowing and the recovery begins. Here is the most dangerous mistake you can make: waiting for the news to tell you that the bottom is in. By the time the anchors on CNBC are smiling again, the market will already be 20% off its lows. You'll have missed the most explosive part of the recovery. The bottom doesn't feel like a celebration, it feels like a funeral. It's the moment when even the most die-hard bulls have deleted their brokerage apps. Look at the VIX, the volatility index. Historically, we don't see a true generational bottom until the VYX spikes into the 40s or 50s. This represents capitulation, the final, exhausted sell-off. When you see the VIX hitting those levels, and more importantly, when you see the Federal Reserve pivot from raising rates to providing liquidity, that is your green light. But don't look for a V-shaped recovery. Look for the disbelief phase. This is when the market starts moving up on bad news. It's the most confusing time to be an investor. The headlines will say inflation is still high, or unemployment is rising, but the stock prices stop falling. This divergence is the smart money quietly filling their bags while the retail crowd is still paralyzed by fear. This is where your opportunity capital from Fan 6 comes into play. While everyone else is asking, will it go lower? You are executing your buy orders. And that leads us to the biggest secret of all. The one asset class that the top 1% used to turn the 2008 disaster into a multi-billion-dollar windfall. Remember the open loop from the beginning of this video? The secret of why the elite did nothing for 6 months, only to emerge as the biggest winners in history. I wanted to know the truth, so I went back and analyzed the 13F filings from the world's most powerful funds, Bridgewater and Berkshire Hathaway, specifically during the bloodbath of Kya for 2008. While the public was panic selling everything they owned, here's what the 1% were quietly doing. They weren't buying the market. They were buying essential monopolies with asymmetric upside. Specifically, they moved billions into preferred equity and distressed debt of companies that the world literally could not function without. Think energy infrastructure, major banks with federal backstops, and dominant consumer staples. They waited until the liquidity black hole we talked about earlier forced these giants to offer once-in-a-lifetime terms just to get cash. Buffett didn't just buy Goldman Sachs shares. He bought a 10% yield plus the right to buy more later at a fixed price. This is the wealth transfer. The 1% use their survival baseline to stay calm while you panic. Then they use their cash moat to buy your future labor at a 70% discount. The asset class isn't a ticker symbol, it's optionality. By having cash when no one else does, you aren't just an investor anymore. Bail out the world, and the world pays you a premium for the rest of your life. But most people will watch this and do nothing. Why? Because their advisors told them to play it safe. Let's talk about why those advisors are dead wrong. So, here is your final blueprint. Calculate your survival baseline. Not for a month, but for a 24-month winter. Build your shield and moat using uncorrelated hyperliquid assets. Abandon the middle zone and adopt the barbell strategy, 90% fortress, 10% moonshots. And most importantly, automate your system so your emotions can't sabotage your future. Now, let's be real. Most certified financial advisors, the guys in the expensive suits charging you 1% to lose 30% of your money, will tell you this strategy is too aggressive or unconventional. They are wrong, and frankly, I would argue that with them, until the market closes, their job isn't to make you wealthy. Their job is to keep you compliant so they can collect fees while the ship sinks. If you follow the advice of the 99%, you will get the results of the 99%. If you want to be part of the greatest wealth transfer in history, you have to stop playing by the rules designed to keep you average. Do you agree? Or do you think the safe way is the only way to survive? I want to hear from you. Drop a comment below. Tell me I'm crazy or tell me your plan. I read every single one, and I'm ready for the debate. And if you're tired of the retail advice and want more strategies the institutions would rather keep secret, hit that subscribe button and turn on notifications. The storm is coming, but now you have an arc. I'll see you in the next one.